Pleasant good afternoon to all our stakeholders joining us. It is our pleasure to welcome you to our first staging of the Barita Beat, the pulse of our performance. I'm Kerry Bayliss, VP of Strategic Business Development and Investor Relations, and also moderator for today's earnings call. The objective of the Barita Beat is to provide a comprehensive update on our financial results, business operations, and future outlook, which will allow you, our valued stakeholders, to stay informed and engage with our progress and allow us to build on our strong culture of transparency and openness. This afternoon, we'll be covering our second quarter financial performance, published May 15th, for the period starting January 1st and ending March 31st, 2023. Our speakers today are Ramon Small-Ferguson, who is our Deputy CEO and also Managing Director of Barita Unit Trust Management Company Limited, and Dane Broadbaugh, our Interim CEO of Barita. We will start with a presentation on the financials, followed by the business review before discussing the company outlook. And at the end, we'll conduct a question and answer session. If you did not already get a chance to pre-submit your questions, you can enter them in the Q&A section that you should see on your screen. I will do our best to answer as many questions as we can at the end of this session. So without further ado, we'll jump straight into the financials, and I'll hand over to Ramon.
Thank you very much, Kerry. I have the pleasure today to talk about our financial performance for the year-to-date period and present to our stakeholders. Let me just get into it here. So I want to start by setting the context of how the market dynamics would have impacted our various business lines and, by extension, our revenue, which feeds squarely into our performance for the 6-month period to the end of March. All right? So our investment banking business line, which focuses on structuring deals for corporate clients, both locally and in the region, would have been impacted by a slowdown in deal flow, driven by the tightening of monetary policy, not only in Jamaica, but across the globe, which would have brought with it an increase in interest rates and uncertainty, which is never a good thing when corporates are trying to make decisions around things such as capital raising. Consequently, during the year-to-date period, we would have seen less deals than the previous year, and therefore a reduction in fees from this business line. Secondly, our money market activities, which really spans our dealings in short-term and marketable securities, which makes up a big part of what we do on our balance sheet. That side of things would have also been impacted by tighter monetary policy conditions as funds became more expensive for us on the funding side of the business, which you'll see when we review our revenue and, by extension, our net interest income. Securities brokerage, another area that's squarely in the lens of monetary policy, higher interest rates, lower liquidity would have adversely impacted this line. Our fund management line actually showed some resilience during this period, primarily driven by the alternative investment side of our fund management business, specifically and in particular our exposure to real estate, which would have actually seen some sort of uplift year over year, and I'll get into those details soon. Our alternative investment business, which really we define as real estate, private credit, private equity, and infrastructure, has really been a ballast, so to speak, with respect to our overall performance year to date, showing low correlation with traditional securities that have been adversely impacted by the state of the market. And finally, our Cambia trading line, Barita Investments, is a licensed Cambia dealer by the Bank of Jamaica. This line has actually seen an uplift year over year in terms of actual revenue from trading volumes, up 12%. So let me just kind of provide a high-level takeaway in terms of our revenue base year to date. Right? We would have seen a 21% increase in total net operating revenue year over year for the 6-month period, up about $1 billion to $5.5 billion. And just to get into the composition, as I alluded to earlier, we have seen a sharp downturn in net interest income, which is down by 65% year over year to 360 million. The key drivers there are simply that our liabilities, largely repurchase agreement liabilities, which mature in 30 days to 365 days, have been repricing faster than our assets. So with rates having gone up substantially year over year in the local and international markets, we're seeing the effects in this line. Right? Our fees and commissions income line, which is largely driven by our activity on the investment banking and asset management sides, is fairly flat year over year, but the composition has changed a bit. As I mentioned when speaking from the previous slide, revenues from investment banking were down year over year because of lower deal activity. But our revenues from the asset management side of the business actually improved year over year, largely driven by higher performance fees with respect to the management of certain portfolios, primarily those portfolios containing alternative assets. Our FX trading and translation gains, despite the fact that I mentioned that standalone, the Cambia business is up 12% year over year, the effects of translation on our numbers, driven by the impact of volatility in the local currency during the period, would have seen us actually lose money over the 6-month period. The dollar was quite volatile and actually showed an appreciation over the period. And consequently, you're seeing an outturn in this line of 58 million relative to 756 million in the previous year, where our fortunes in this line were more favorable. Right? Moving to gain on investment, which represents the substantive portion of our revenue during the period. This line really relates to the results of our on-book investment activity via both traditional and non-traditional assets. And as I mentioned when speaking from the first slide, during this period, which has been rife with volatility in traditional markets, our exposures to alternative assets have actually helped to offset certain losses on our traditional portfolio. So our exposure to real estate assets, our exposure to private credit and private equity assets are showing up. The results of that are showing up in this line, which is up year over year by about $2.3 billion. So just to talk a bit about the middle line or the operating expense line. Similarly, we're seeing an uplift in this line year over year from 1.7 billion in the corresponding period to $2.1 billion. That's decomposed into 3 main segments. Staff costs, which relate directly to the cost of the people who produce the results for the organization, is up by about 110 or so million Jamaican dollars. And this is really driven by our continued investment in talent, which are central to our transformation strategy as we enter, or as we are in our 5th year post-acquisition. Right? On the admin side, we are seeing an over $500 million increase. And this is really driven by the investments that we continue to make in our customer experience and efficiency. On the customer experience side, we have made investments in the physical environments that our customers occupy. But we have made some landmark investments in technology, which will soon redound significantly to the benefit of our customers from an experience perspective, and which we would have telegraphed in our various public communications before now. And finally, the expected credit loss line, which is the third category, is actually seeing a reversal year to date as our balance sheet has been recomposed to be less risky, so to speak, from the perspective of expected credit losses. So we're seeing some reversal of those entries during this period relative to last year, where there was a positive entry of 58 million. Overall, our efficiency ratio, which looks at our total expenses, our total non-interest expenses over net operating income, it's about 39% during the period, which is within the tolerance level that management has set for itself. So just to talk a bit about the balance sheet, total assets are up 9% relative to the audited September 22 period. We have breached the $120 billion mark in terms of total assets, and that was driven primarily by a growth in pledged assets and marketable securities, so investment securities, by about 16 million. We've also seen a fall off in our loan portfolio, which is not unusual. Our loan strategy really is divided into two pieces. One is a margin loan portfolio where we extend credit to our clients against their marketable securities. And the other is really the segment that enables our investment banking business. So where we may give loans in furtherance of our investment banking business. There may be bridge loans that eventually get converted to capital market type transactions. And the fall off year to date is really attributable to that kind of conversion happening. On the liability side, we have grown our funding base. Total liabilities are up 8% year to date relative to the audited September 22 period. And that has been driven primarily by a growth in repurchase agreements, which are up by about 8 billion year to date, and a growth in other debt facilities, which really relates to monies that we would have raised wholesale in capital markets and otherwise, which is up about 800% year over year. Shareholders' equity has grown by 12% year to date to $36.1 billion. I mean, this represents the source of our capacity to actually go out there and pursue our strategy, and also the source of our capacity to manage the risks attendant to the business that we're in. And our earnings per share, which is our primary metric, adjusted metric from a net profit perspective, was up 14% to $2.16 during the period, on the back of a 13% rise in net profits after tax, which closed the period at $2.6 billion for the 6 months period. So just to speak a bit more about our capital, right? So in nominal terms, we saw that growth in the capital to 36.1 billion. But if we look at our main barometer in terms of our capital to risk-weighted assets ratio, we would have closed the period at 34.4%, which is more than 3 times the regulatory minimum of 10%, and over 10 percentage points higher than the industry average as at December 2022, which is the last set of information that has been made public. I mean, this really is a testament to the organization's financial strength and health. And again, it speaks to the company's ability to manage risks wherever they may come from, but also the company's ability to pursue opportunities as they present themselves. Just wrapping up, just to kind of look at most of the main highlights in one place. Operating revenue, 5.5 billion, up a billion year to date. 2.6 billion in net profits, up 13% relative to the corresponding period last year. 36.1 billion in shareholders' equity. 120 billion in total assets. 39% efficiency ratio. Just under 15% in terms of the ROE metric. And our leverage is still pretty modest, looking at total assets over equity at 3.27 times. All right, at this point in time, I'm going to hand over to our interim CEO, Dane Bradber, who is going to get a bit deeper into the strategy and the drivers of the outcomes that I've just discussed. Thank you.
All right. Thanks, Ramon. So, we've discussed our financial performance, but it's important to know that these are outcomes of the operational integrity of the business and the conscious decisions that would have been made early after Cornerstone's acquisition of Barita. So I'll talk a bit about the various elements of Barita's resilience and how it supports, in particular, our investment strategy. So first, let's look at the context for our performance and outlook. So we're seeing signs of improvement in both the local and the global inflation picture. with inflation now just within the BOJ's 4 to 6% target range at 5.8%. And global inflation cooling, though still well above target levels. So the extent to which inflation, and by extension, interest rates are expected to subside, however, are somewhat counterbalanced by the positive growth expectations as the economy approaches pre-COVID levels. Meanwhile, the successive global growth forecasts continue to be adjusted lower, particularly in advanced economies, thus heightening the probability of a global recession. So pretty much, while the local trajectory is positive, global growth expectations are such that the business environment is expected to remain challenging. So, to characterize our performance, rising rates associated with monetary policy and the challenge returns on traditional asset classes would have impacted our more traditional business lines such as net interest income, as Raman showed, and securities trading. However, our exposure to alternative investments and their low correlation with traditional asset classes, particularly based on our strategy, would have provided much needed diversification benefits and contributed to the growth in our net operating revenue. Now, we expect this diversification benefit, through alternative investments to continue to be a feature of our revenue, albeit perhaps to a lesser extent than we've seen year to date. So we'll talk about our alternative investment strategy, right? And this strategy was really conceived based on our outlook from as far back as 2019. So, we saw where rates were accommodative globally for a long time, and risk asset prices were, as a result, were elevated, and consequently, marginal risk premiums were elevated, and consequently, the marginal risk premiums would have been pretty marginal. And we anticipated that a downturn in these assets was on the horizon. At the very least, the return for the associated risk, for example, interest rate risk, in our view, was not enough to have our capital solely committed to these assets. So as a result, we'd have made the deliberate decision. I would have started the groundwork and the negotiations that would have formed the basis for our current alternative asset exposure, particularly in real estate, but also in private credit and private equity. And we similarly took the deliberate decision to build our capital base through serially raising $34.5 billion between 2019 and 2021. Now, alternative investments typically tend to be less liquid. So it was important for us to have a stable funding base, right? Capital is typically the most stable, to support that strategy. Well, thankfully, these decisions have borne fruit in recent times, as the returns from our alternative investment exposure would have offset challenges that we'd have had in our traditional business lines. And a strong capital buffer has allowed us to fairly comfortably absorb shocks associated with a rising rate environment and other elements of volatility that we would have seen in the market. So, we mentioned our deliberate efforts to build our capital base on the previous slide, and we talk a lot about our capital base, and for good reason. So let's look at really what it does. So, our shareholder equity currently stands at $36.1 billion, which is 28% of the capital of the securities dealer industry, according to latest industry statistics. Our capital adequacy ratio, which measures the extent to which our capital is able to absorb shocks and associated losses, stood at 34.4% versus a minimum regulatory requirement of 10%, early warning level of 14%, and an industry average of 24.1%. Now, what this does, firstly, is really give us superior ability to grow. So as opposed to being reliant on retained earnings over time to fund our growth, we chose to raise our capital upfront to really secure our growth capacity, which we expected would be in excess of and faster than what our retained earnings would be able to provide. Now, as I mentioned previously, it serves also as a stable funding base to support our investment strategy. So, as a general liquidity management principle, less liquid assets should be generally supported by more stable funding. And our overweight capital levels relative to alternative asset exposure embody that. Finally, in the interim, it gives us fairly great ability to withstand shocks. This is why, for example, even with the net 3.8 billion in fair value losses through OCI that we had up to the end of financial year 2022, we still maintain ample capital adequacy levels of 33%. And in fact, could withstand over 5 times greater shocks and stay well within the FSC's early warning levels. This is why, for example, we're able to unequivocally say to our customers that they will be made whole in the event of any occupational fraud. So we build the capacity to withstand shocks, but we've similarly invested in the frameworks that adequately control the extent to which we have that exposure, and by extension, protect our shareholder and other stakeholder value. So this is through our deliberate investments in our risk frameworks, for example, our enterprise risk management framework. This is through our investments in overhauling our policies and procedures. This is from onboarding of top talent in our second and third lines of defense, as well as very strong risk management know-how in our first line of defense, all with exposures to global best practices to really build and maintain our risk frameworks. Right? This is through the technology enhancements and investments in our tech infrastructure that we've made to future-proof our business and reduce non-financial risk. And it is through our focus on governance to ensure the independence of our board subcommittee chairs and the independence of elements of our internal audit function. So, a static control environment, as strong as it is, eventually, for those with strong enough intent can get figured out. So what's therefore important is the continuous changes to our control environment through continuous improvement. Right, we've come a very long way in crafting our risk control and governance environment, but we still continue to make improvements. So overall, what I'd say is that we've cultivated the risk capacity to really support the nature of our investment strategy through a stable funding base and the resilience of our capital to market shocks. Similarly, our risk capacity gives us really tremendous room for growth, especially given Barita's low level of 3.3 times relative to the industry average of 6.7 times. So this now, for example, provides the business with opportunities to introduce more debt into its capital structure as an efficient way to fund the acquisition of assets that can increase returns for shareholders, and also add to the more stable funding base that supports our investment strategy. So finally, I'll talk a bit about what we have recently announced, which is the no objection our affiliate Cornerstone United Holdings Limited would have received to reorganize the licensed entities that its shareholders commonly own in conjunction with Barita's parent company, Cornerstone Financial Holdings Limited, as a financial group. Now, the reorganization will see Barita and its subsidiary, Barita Unit Trust Management Company Limited, along with its sister company, Cornerstone Trust and Merchant Bank Limited, becoming subsidiaries of a newly formed financial holding company. Now, we see this as unlocking real value for Barita and by extension, the group. In essence, it allows us to optimize the group. It allows us to optimize our efficiency as we look to optimize the use of resources and optimize processes across our subsidiaries. Most exciting, for me at least, it allows customers access to a broader range of financial services and allows us to further optimize how we deliver those services, including how we're structured to deliver. Now, we're at the early stage of the process, having just received a no objection, and we'll share more information as appropriate. So, thanks again, everyone, for joining our first investor forum. It was a pleasure engaging you to talk about our business today, and we'll be available for a few more minutes to take your questions. Carrie?
Thank you to both Ramon and Dane for taking us through the financials, our performance, and a lot of important, pertinent information that I think all of our stakeholders would have wanted to know about. Right, so we're going to move into the Q&A questions. We do want to hear from you. So again, just a reminder, if you have anything that you want to ask, please go ahead and enter it into the Q&A section that you're seeing on the screen. And while you're doing that, I think we'll start with some of the pre-submitted questions that we would have gotten. All right. So The first question we have is, what effective method is Barita using to grow the business within the next 3 to 5 years?
Yeah, thanks for that question. So overall, I'd characterize the strategies that we're embarking on. Really, again, we continue to invest in our technology to really optimize the way that we're able to deliver the various services to our clients and to optimize our business itself. Want to optimize the way that we engage our clients through optimization of our sales architecture. We also, I mentioned in my presentation, the excitement that we have regarding the reorganization, and we think that exercise in particular, as we go through that and optimize the business, will allow us, particularly just based on the broader range of financial services that we're able to provide the clients as a group, to be a significant area of growth for us. And importantly, we see the risk capacity that we have that's embedded in our capital levels as a significant lever that we have for growth over the next few years.
All right. Thank you for that, Dane. So we have a 2-part question here as well. Somebody's asking, what are Barita's plans where real estate is concerned?
Oh, sure. All right. Thanks, Kerry. So good question. So, we would have, again, discussed this at great length in our various public releases, both our annual reports. I think at our last AGM, we would have made some mention as well, and in our ongoing reports to our stakeholders. So how we see our role with respect to real estate is how we see our role in any other asset class. We're an investor. We dispassionately evaluate and seek out value throughout the spectrum of investment assets. We have opted to get some exposures in that area, and really what our objectives are from here on in, having put together and curated a portfolio of what we think is very prime real estate with a whole lot of latent value. What we're seeking to do at this juncture is to align ourselves with the right group, with the right partners, to really get highest and best use extracted from those assets from here on in, with the view of creating as much value holistically for all the various stakeholders as possible. And we view those stakeholders as there are multiplicity of people invested here. One, we want to drive economic growth, of course. 2, we have a duty to our shareholders in terms of the exposure that they would have through our involvement to get the best value. And we think that just based even on some of the plans that we have for some of the plots of land within our span, we think we can actually have a tangible impact on Jamaica, on moving things forward in those various areas, which really drives us to our core. So we're excited about the future in relation to our involvement with real estate from that perspective.
Thanks, Ramon. All right. So we have quite a few questions coming in about the reorganization of the company. So I'm going to start with a few of those. So some of the questions are, what's the reason behind the financial holding company takeover, and when will that new structure be in place?
Okay, so I wouldn't characterize it as a financial holding company takeover. Really, so it's really a reorganization of Barita and its sister company CTMB under a financial holding company, right? So substantively the ownership wouldn't change. Currently, Barita's parent company is Cornerstone Financial Holdings Limited. Our sister company, Cornerstone Trust and Merchant Bank, its parent company is Cornerstone United Holdings Jamaica Limited. Now, both of those entities have common shareholders with a common proportion of shareholding. And as is required, when there are 2 licensed entities, especially when it includes a DTI, they're required to organize as a financial group. So what this really is doing is really having both entities now under one common parent, which will be this newly formed financial holding company. Now, the timing of it is not certain at this point. We'd have recently received the no objection. So we're currently executing the foundational steps to get that going. And of course, the future steps will definitely include consultations with our shareholders and various other stakeholders. So I can't yet speak to the timing, but we're executing the foundational steps in the interim.
Thanks, Dane. So 2 follow-up questions. Just to clarify, we're asking, why does Barita need to be delisted, and how will the reorganization affect existing Barita shareholders?
So what we would have done in our press release would have really telegraphed an early intention to list the FHC, right? That's really the more substantive aspect of things, which would include Barita shareholders being offered shares in the FHC. Now, based on our view, we thought this to be most efficient for the group and best for shareholders, given the shared strategic journey of the group and the ability to more efficiently allocate the group's resources. Now, again, this is going to be subject to the consultation process, right? So, it's not necessarily, again, we'd have telegraphed our early intention. It's pretty early in the process, but that was the view that we had on the listing of the FHC at the time.
Thank you, Dean.
I just want to add to Dane's comments. Good afternoon, everyone. I'm Jason Chambers, Chief Investment Officer for the Cornerstone Group. This reorganization is a path that has been taken by several institutions besides Barita Investments. This is not anything new to us. It's pursuant to Bank of Jamaica regulations. It allows for consolidated reporting. And what it's doing, what the regulator is doing, is making the regulatory environment safer for everyone. So it's a step in the right direction from a prudential risk management perspective to safeguard the industry and by extension, safeguard you and your investments. So our group will more formally come under the supervision of the Bank of Jamaica, subject to us being issued an FHC license, which is a second step. So far, we have only been given the no objection for the first step, which is to go ahead and reorganize. Importantly, and I'm not sure if Dane had touched on this, but importantly, it will be giving potentially Barita's existing shareholders exposures to other areas of the group, certainly the banking segment of the group, for which we have really exciting plans. We believe that we have significant value to deliver to Jamaica, and you, our shareholders and potential shareholders who are on this forum, will stand to benefit from being able to access those benefits. So this is something that you should be excited about. If we are coming to market to provide you with, for example, FHC shares as a substitute for Barita shares, is something that you should be looking for to that prospectus with excitement to see what additional opportunities are there for you. But as Dane says, this is subject to consultation with all relevant stakeholders. So we have not baked exactly how this will pan out, but there is absolutely no element of this restructuring that should give you a moment for pause or anxiety. It is clearly an opportunity for you for the various reasons outlined prior.
Thank you very much, Jason, for that additional clarity. I think it's very helpful. All right, we have another question here asking about investment portfolio recommendations for young professionals. So I'm going to just let this person know that to please visit our website or call in so we can connect you with an advisor that can help you to start your portfolio and make those recommendations. I'm just going to give one more minute to see if any other questions do come in. All right, ladies and gentlemen, I think that brings us to the end of our quarterly earnings call. So I'd just like to take this opportunity on behalf of the entire Barita team to thank you very much for spending your lunchtime with us and to coming to hear about our financial performance and joining in the conversation with your questions. It's been our pleasure to host you and to speak with you as always. I just want to wish everybody a great afternoon. Thank you.
Today is Read Across Jamaica Day. What a day it has been. Do you know that it started very early for many? Yes, at CVM this morning, there were a group of persons very, very early reading to our nation's children. All over Jamaica today, we have corporate groups and companies and individuals. We have parents also who have moved into the school and literally take over just to read to our children. On behalf of the National Child Month Committee, I want to extend my thanks to each and every one, and a very special thanks to Barita for joining in this initiative and to have done so well with the children, reading for them, telling stories, helping them to enjoy today. Of course, it's all about the children, and as adults, yes, we got involved. As the theme for National Child Month Committee said for this year, children need our love and attention.
Today, the Barita Foundation team has joined with the Barita Investments team and the Cornerstone Trust and Merchant Bank team to read to our students here, our little loved ones at the Wilbert Stewart Basic School. We're so excited to be a part of Read Across Jamaica Day again, one of our many Child Month activities. We are living the theme of knowing that our children need our love and protection, and we're getting involved. I hope everyone gets involved today and that our children will be impacted positively from all the reading, storytelling, and just engagement of our adults, especially from corporate Jamaica and the parents and friends of our children in our communities. So happy Read Across Jamaica Day!
Our investment banking team is committed to raising capital and providing strategic advice to grow your business. Our clients are global, and because of this, the world continues to be our playground, creating endless opportunities. That means when our clients win, we win. For 45 years, we have been helping our clients to get ahead, and our team is always willing to provide the most creative financial solutions to assist our clients' businesses to grow. Over the years, we would have completed many notable transactions, and guess what? We have a lot more on the horizon. Look out for Barita raising capital for its clients operating in the energy sector, construction, real estate, infrastructure, manufacturing, information technology, financial services, distribution, and hospitality industries, just to name a few. Our investment banking unit stands ready to serve you, raising capital to revolutionize your business and ultimately your relationship with money.
Barita believes your best path to wealth is the one that works with how you move. We offer ultra customized portfolio management for the discerning clients looking for partial to full portfolio management services at a mutually beneficial fee and other considerations. You tell us your destination and we'll help navigate the roadblocks and obstacles ahead. Visit barita.com/goals to learn how to accelerate your wealth journey and move you closer to your goals.